Lesson 7. Multi-Timeframe Backtesting. I want to show you something that surprises almost everyone the first time they see it. You take a strategy. You run it on the 5-minute chart over 3 months, and it makes 150 trades and returns 12%. Same strategy, same 3 months, but on the 1-hour chart, it makes 30 trades and returns 16%. Same logic, same market, same period, just different candles, and the result is barely recognizable. That gap is what this lesson is about, because once you understand it, you stop asking, is my strategy good? And you start asking the better question, which is my strategy good on the time frame it was actually built for? Why the time frame changes everything here is the thing people miss. A candlestick chart isn't just a picture of price. Each candle is a summary. The 1-minute candle takes all the price action of 60 seconds and compresses it into an open, high, low, and close. The 1-day candle takes 24 hours and does the same thing. So when you run a strategy on the 1-minute chart, you are feeding your logic tiny, noisy summaries. When you run it on the daily chart, you are feeding it calm, smooth summaries that have already digested a lot of the noise. This is why the same strategy behaves so differently. It is the same market, but the strategy is reading it through completely different lenses. And there are really 3 forces that drive the difference. The first is noise. Short time frames have a lot of it. A 1-minute candle will jump around because one big order, one whale, one news headline can move the price for 60 seconds in a way that means nothing 5 minutes later. Daily candles filter most of that out, because by the end of a day, the noise has cancelled itself, and what is left is the actual trend. The second is fees. Every trade costs you something. On most exchanges, around 0.1% per CD, so roughly 0.2 round trip. That sounds tiny. But if your strategy trades 150 times in a month, you are paying 30% of your capital in fees alone. If it trades 30 times, you pay 6%. The fee rate didn't change. The number of trades did. The third is the size of the move per trade. On a 5-minute chart, a typical move you might capture is 0.5%. On a daily chart, a typical move is 3 to 10%. That changes everything about stop-loss placement, about how much heat you can handle psychologically, about how much room you give a trade to breathe. So, when somebody tells you their strategy returned 20% in a backtest, the first question you should ask is, on what time frame? Because the time frame is doing a lot of the work. How to choose a time frame? I am going to give you 3 principles, and they're the ones I actually use. The first is honesty about your time. How much attention can you really give this? If you can sit in front of the screen 8 hours a day, you can run something on the 5-minute or even the 1-minute chart, because you can react when things go wrong. If you have a day job and can check your phone twice between meetings, you have no business on a 5-minute chart. You'll come back from lunch and find the move already happened without you. For most people with day jobs, the 15-minute to 1-hour range is the sweet spot. If you can only look once a day, you are on the 4-hour or daily chart. Full stop. The second is your risk tolerance per trade. This surprises people, but the longer the time frame, the bigger the swing per trade. On a 1-minute chart, a single trade might move 0.5% against you before you exit. On a daily chart, the same trade can be down 5 or 8% intraday before it comes back. Your stop loss has to be wider, your position has to be smaller relative to your capital, and you have to be able to look at red numbers in your account without panicking. Some people can't. That is not a moral failing, it is just information. Use it. The third is the kind of strategy you are running. Trend-following strategies want longer time frames, because trends take time to develop, and you need each candle to smooth out the wiggles. Mean reversion strategies, the ones that bet on price snapping back to average, work better on medium, short timeframes where price oscillates more often. Breakout strategies tend to like the middle 15-minute to 4-hour. If you put a trend-following strategy on a 1-minute chart, it will get chopped to pieces. If you put a mean reversion strategy on a daily chart, it'll take 1 trade a quarter and you'll die of boredom. What each tier of time frame actually feels like, let me walk you through the 3 groups so you can feel the difference instead of just reading numbers. The ultra-short stuff, 1-minute to 5-minute, is a different animal. You get tens or even hundreds of trades a day. Your capital turns over fast, and you find out whether your strategy works in days rather than months. That sounds great, and it is the appeal. But the dark side is brutal. Most of your signals are noise. Fees can eat 30 to 50% of your gross profit. Slippage, which is the gap between what your backtest assumes you got filled at and what you actually got filled at in live trading, becomes a real problem. Because at that speed, the price moves between the moment your signal fires and the moment your order reaches the exchange. A 1-second delay can turn a winning trade into a losing one. And the data is huge. A year of 1-minute data for a single pair is over 500 megabytes. Backtesting is slow. I am going to be blunt with you. I do not recommend ultra-short timeframes for beginners. Your backtest will look better than your live results every time, because the live market is meaner than the simulation at that speed. The short term, 15-minute to 1 hour, is where I think most people should start. Signals are cleaner because the noise has been partly filtered out. You'll see maybe 5 to 20 trades a day on the 15-minute, fewer on the 1 hour. Fees drop to a manageable 5 to 10% of gross profit. The data is reasonable, backtesting is fast, and execution speed matters less. A few seconds of delay won't kill you. You do still have intraday volatility to sit through, and on the 1 hour you can be holding a position overnight, which brings its own risks we'll get to. But for learning, for iterating, for building intuition, this is the band I'd point you at. The medium to long term, 4-hour to daily, is a calmer world. Signal quality is high because each candle represents a meaningful chunk of market consensus. Fees are basically a non-issue, under 2%. The average profit per trade is much bigger, often 3 to 10%, which feels good. You don't have to watch the screen. Slippage barely matters. The cost is opportunity. You might only get a handful of trades a week, sometimes fewer. Your capital sits in trades for a long time, and the volatility per trade is large. So psychologically it can be harder, not easier, even though you are checking less often. There is also overnight risk, especially over weekends. Crypto doesn't have a closing bell, but the wider world does. A US market sell-off on a Friday afternoon can drag crypto down hard. And there is nothing you can do about it from Saturday to Sunday night. Some traders handle this by force closing positions before the weekend, and Freqtrade does support that. Through a custom exit function you can put in your strategy. You write a small rule that says, if it is Friday evening, close everything. It is worth knowing that is available, matching the time frame to who you are. There is a useful shorthand here. Day traders, the ones who close everything before they sleep, usually land on 5-minute to 15-minute, and they tend to run mean reversion or breakout strategies. Swing traders who hold for days to weeks, sit on the 1 hour to 4 hour and chase medium-term trends. Trend traders who hold for weeks or months and only want a few trades a month, live on the daily chart. The take profit settings scale with that. A day trader might be happy with 2% and exit anything still open after a few hours. A swing trader might want 10% and give a trade 3 days. A trend trader might shoot for 30% and let it ride for a month. These are choices, not rules, but they line up naturally with the time frame because a 30% move doesn't happen inside a 15-minute window. The actual experiment here is what I want you to do once you've got a strategy you trust. Take one strategy, one pair, and one time range. I usually use Bitcoin against USDT over a 90-day window because it is liquid and the data is clean. Then run the same backtest on 5 timeframes. 5-minute, 15-minute, 1 hour, 4 hour, and daily. You can do this manually, one command per timeframe. Freqtrade's backtesting command takes a timeframe flag, so you change one argument and rerun, and this is what I do. You wrap it in a tiny shell script that loops through the timeframes and prints the results one after the other. Either works. The point is the comparison, not how you generate it. When you have the 5 reports in front of you, the easiest thing is to drop them into a simple comparison table: trade count, win rate, total profit, average profit per trade, maximum drawdown, Sharpe ratio, and the percentage of profit eaten by fees. Those 7 numbers tell you almost everything. Let me show you what a real result looks like, because the numbers themselves teach the lesson. This is roughly what comes out of a typical trend-following strategy tested across all 5 timeframes over the same 3 months. On the 5-minute chart, you get about 247 trades, a 68% win rate, and 12.5% total profit. Sounds good. But the average profit per trade is 0.05%. Basically a rounding error, and fees eat nearly 20% of your gross. The Sharpe ratio, which is a measure of risk-adjusted return, is 1.85. That is the lowest of the bunch. The strategy is working hard for very little. Move up to 15 minutes and the picture changes. 89 trades, 75% win rate, 18.3% total profit, average profit per trade of 0.21%, fees down to under 10%, Sharpe up to 2.65. Same strategy, same period, we just gave it cleaner candles. The 1 hour chart is where it peaks for this strategy. 31 trades, 81% win rate, 15.7% total profit, average profit per trade of 0.51%, fees under 4%, Sharpe of 3.12. Total profit is slightly lower than 15-minute, but every other number is better, and the drawdown is the smallest of the group. That is the sweet spot. The 4-hour chart gives you 12 trades, 83% win rate, 9.2% total profit, average profit of 0.77%. Quality is high, but the sample is getting small, and total profit is dropping because there just aren't enough trades. The daily chart gives you 4 trades, all winners, average profit of 1.70%, total profit of 6.8%. Beautiful numbers on paper, but 4 trades is not a sample. You can't conclude anything from 4 trades. It could be luck. So the lesson from this experiment is the lesson I want you to remember. There is no best time frame. There is a best time frame for your strategy and your constraints. The 5-minute chart isn't bad. It is bad for this strategy. The daily chart isn't good. It is good for this strategy but statistically meaningless on this sample size. How to actually decide when I am picking? I look at the trade-off between total profit and Sharpe ratio, with a penalty for fee percentage and a hard requirement on sample size. The 15-minute and 1-hour results usually win for the kind of strategies I run, because they balance return against stability. Total profit alone is a trap. A 20% return with a Sharpe of 1.2 and a quarter of your gains eaten by fees is a worse strategy than a 15% return with a Sharpe of 3 and a fee load under 5. The second one will survive live trading. The first one probably won't. And here is the part I have to be honest about. The same way I was honest about backtests in general. A short time frame strategy that backtests beautifully often falls apart live. Slippage eats the edge. Latency eats the edge. The longer time frames are more forgiving, because a strategy capturing a 5% move can absorb a sliver of slippage without noticing. A strategy capturing a 0.5% move cannot. A couple of practical traps. 2 things trip people up when they do this experiment. The first is missing data. You'll run a backtest on the daily chart over 90 days and Freqtrade will throw an error saying no data found for that time frame in the range. That is almost always because you only downloaded the 5-minute data and assumed the others would come along. They don't. You have to explicitly download each time frame you want to test. One download command with multiple timeframes listed, and you are set. The second is drawing conclusions from tiny samples. If your daily chart backtest only has 4 trades, you cannot say the strategy works on the daily chart. You can say it had 4 good trades. To actually validate a daily strategy, you want at least a year, ideally 2, of data. The longer the time frame, the longer the test period you need, full stop. There is also a more subtle trap, which is reading too much into one period. If you only backtest over a 3-month window, you are testing one market regime. Maybe that was a bull run. Maybe it was choppy. Your strategy might shine in one and die in the other. Run the comparison across different market environments. A strategy that is robust across timeframes and across regimes is a strategy you can actually trust. A strategy that only works in one specific cell of that grid is probably overfit. Wrapping up the headline of this lesson is simple, and I'll say it the way I'd say it to a friend. The time frame is part of the strategy. It is not a setting you pick at the end. It shapes the noise, the fees, the move size, the sample, the psychology, everything. The practical version is this. If you are new, start on the 15-minute or 1-hour chart. Get a feel for it. Build a comparison table with the 7 numbers I listed across at least 4 timeframes. Look at where your strategy actually performs, not where you wanted it to perform. Be honest about how much time you can give the screen. Be honest about how much volatility you can stomach in a single position. and give yourself enough data that the daily chart results mean something. If you do that one experiment, run one strategy across 5 timeframes over the same period, and sit with the comparison table for 10 minutes, you will understand more about your strategy than most people learn in months. It is worth doing once, properly, before you touch anything else.